What is a bank reconciliation? Before we get deeper, what is to reconcile? To reconcile is to make one thing compatible with another. In other terms, we are trying to make two things match. In accounting, they say accounts have to balance. So certain transactions have to match. So a bank reconciliation, with the proper definition, is the preparation of a report or statement to match the bank transactions recorded in the books of accounts with the bank statement. So we are matching two things. What are the two things? The bank statement and an extract from the cash book. One may then ask, so where do we get the bank statement from? Our source of the bank statement is the bank itself. So the bank issues us a bank statement. And where do we get the cash book from? So our business issues us with a bank or cash book prepared by the business. So the bank statement is prepared by the bank. The cash book is prepared by our business. In reconciling then, we are matching the transactions in the cash book and the transactions in the bank statement to come up with a bank reconciliation statement. For accounting beginners, I would encourage you to request your guardians for any bank statements, maybe a school bank statements for your fees or any other. It's good to have a feel of what you are learning in reality. Just go have a look at it. Just look and try understand it. It helps. You might not know it, but I do. Trust me, it helps. Why do we perform bank reconciliations? So the points noted are verification to prevent and detect fraud, to detect errors. So let's begin with the verification. So do we have in the bank account what the cash book says we have? We are claiming we have money. Let's say we have $500 in the bank. That's what we are claiming we have in the bank. But do we really have it? Let me give an illustration. So a customer may have bought goods on credit last month. So put yourself in a situation. A customer, you are the accountant at the business. A customer bought goods last month on credit at $500. What then happened is the customer transferred the funds from his or her account to our bank account. The customer comes with a proof that they transferred the amount to us. So they come with the proof to us. In our books, the cash book, we go and debit $500 because we have seen on the receipt that it has been paid. So we debit the cash book account. We are increasing the cash we have because we have been added more cash. So we go and debit in the cash book. However, the transaction may have bounced back to the customer. We do not know it because all we know of is the receipt we have. The only way we are going to know of this is through looking at a bank statement. So I'll get to the bank side. I'm explaining for this illustration. First, I'll start with the business side. So they come with the receipt. We record $500 to the debit of the cash book. We are saying in our business, according to our records, we are saying the bank owes us $500. The bank has our $500 as a business because the customer paid to the bank $500. However, at the bank, the transaction bounced back to the customer which means $500 came in, $500 went out. What we're saying is the transaction was reversed. So the customer may have sent the money, but maybe due to a technical problem, the transaction was sent back to the customer, which means the customer did not pay. Why? Because we are saying it was cash in, cash out. By cash in, cash out, I mean I give you $2, you give me back my $2. It means I did not give you anything, because you're still remaining with zero. That's what happens here. The bank was given $500. The bank lost $500. That's the explanation there. So the bank has no money from the customer, but we at the business are saying you, the bank, have money from the customer. So the bank then issues us a bank statement that shows us that now that we know that no money is in the bank account, we are verifying if the money we were claiming we have is really in the bank account. So let's go on this next stage. That's the verification. This verification point I was talking about. Let's go to the next. To prevent and detect fraud. So to prevent and detect fraud, most of the time when we think about fraud, we think of theft. Yeah. So let me explain theft, since it's a general example. So is theft occurring by stuff? So let me explain this with a little example. The business may have received cash from customers. So they may have received a cash payment from customers. So now the business now wants to deposit its money to the bank. They now want to put their money to the bank, maybe for security reasons, or maybe by policy. It's their policy. They just have to put the money they receive into the bank. So what may happen is the business may send an accountant, right? They send their accountant, not just a general account, their accountant to the bank with the money. The accountant may steal, let's say, $300 from the money that it was sent with. So the money, let's say in whole, let's say the money is $1,200. The accountant steals $300. So we are left with $900, is it? Yes. So we are left with $900. According to our cash book, we have 1,200. Why? Because in our cash book we recorded 1,200. Then we gave the accountant the money. The accountant, on his way, he took 300. So the bank is going to receive only $900. What then happens is, when we try to reconcile the bank statement from the bank and the cash book extract, we're going to see that there will be a difference of 300. That 300 which was stolen by the accountant. So the bank reconciliation will tell the one doing the reconciliations. So the bank reconciliation, yes, will tell the one doing the reconciliation of the difference, and the one doing the reconciliation may easily identify where the fraud or error, the fraud occurred, right? I hope there you got it. Let's go then to detect errors. So in detecting errors, we mean, are checks dishonored? Let me explain what a check is first of all. A check is a document, a legal document, which is made by the bank. So it's a form of money I may say. It's an instruction, not just a form of money. It's an instruction. So I think you should ask your mom or your dad to show you a beta check, what you used to call a beta check. It's a type of a check, or they can show you an actual bank check. So a check is an instruction. If you actually check on the beta checks, the Zimbabwean beta checks, I think we used those around 2008. They actually state this document is an instruction. They actually state that on the beta checks. So let me explain the check, the bank check, not the beta check. We're not talking about the beta check for now. So check is an instruction. So I was talking of the beta checks so that I just give you a reference, or maybe just an easy reference to the definition of a check. So on the beta check, they actually state this note is an instruction. So that should actually ring into your mind to define a check. A check is an instruction. So checks were a document which, if I owe you, then you would come to me and then I would write you a check. You would go with the check to my bank, and the amount written on the check would be transferred to your account. Let me explain this. Chipo owes John, right? Chipo owes John $500. So John goes to Chipo, right? John goes to Chipo. I hope you're writing this down because it gets confusing. The content is increasing, so it gets confusing. So John goes to Chipo, then requests for a check. So Chipo will write on the check $500 and we will sign it. So the check will be under Chipo's bank, the bank that Chipo uses. So then John takes the check, goes with it to Chipo's bank, submits it, then the amount is transferred into John's account. So that's how a check used to operate, and that's a check. So when we say checks are now dishonored, like checks dishonored, what we mean is that check which John is taken from Chipo and went with to the bank has rejected it. Reasons for rejecting a check is that there may be no funds in Chipo's account. So John went and collected a check for $500 from Chipo. John went to the bank. However, in Chipo's account, there is only $2. So this cannot cover up the $500, and the bank is not under any instruction to give Chipo an overdraft. So now John has to go and record a dishonored check because the check has been rejected by the bank, because maybe there are no enough funds, or the signature does not match the right signature that Chipo should be writing. So actually the bank will actually compare if the signature that Chipo had registered the bank with is the same signature on the check for security reasons, right? So that's a dishonored check. A dishonored check is a rejected check. Why? Because there may be no enough funds in the bank account of the one who issued the check. Also, are payments or receipts missing? So we're talking about errors, remember? Are payments or receipts missing? What we mean then is, on the bank statement, Are there any payments we made that are not there? Are there any monies we received that are not on the bank statements? If yes, then what do we do with those? We adjust them, right? We should adjust for them. I'll explain how we adjust them as we progress. So our payments or receipts missing, maybe in the cash book or on the bank statement. So there may be payments that the bank made on our behalf, but we in the cash book, we did not know of them. So now that we have the bank statement, if we see them, we jot them down in our cash book, right? I hope you're getting me there. So let's go next on to the next screen. So I've explained cheques, and I hope you understood cheques. Now I have to talk about the reasons why balances may disagree. So the reason why balances may disagree is that we as a business may have paid suppliers with a check. Now remember, a check is a note that is an instruction to transfer funds from one account to another. So we may have paid a supplier with a check, so the supplier has to go with the check to the bank so that the amount may be transferred from our account to his account or her account. So from our account to the supplier's account. However, the supplier may not go with the check to the bank. Why? Because the supplier may fall sick, or the supplier may have some plans that may have disturbed him on his way to the bank, or the supplier may have forgotten actually about it. So these unpresented checks, what they do is they actually make the bank statement and the cash book not balance, because in the cash book we are going to we have lessed the amount that we have paid to the supplier. So in the cash book, in the business, the cash book is in the business, we are saying we have paid the supplier $500. However, the supplier did not go with the check to the bank, so the bank is saying we did not pay anyone. But in the books of accounts in the business, we are saying we have paid the supplier. The bank is saying we did not pay anyone, because the bank did not receive the instruction, right? The bank did not receive the instruction. So since we have less $500, let's say it was $500 in our books of accounts in the business, it means that the balance between the bank statement and our cash book is going to be different with an amount of $500, and the bank statement will actually be bigger than the cash book. Why? Because in the bank statement they did not pay anyone. In our cash book we paid somebody. That's according to our records. So that is one of the causes of disagreements between the balances. We also have outstanding lodgements or uncredited lodgements. By outstanding lodgements, what I mean is we may actually have received a check. This time it's us, the business, receiving the check. So the business receives the check, the business submits the check to the bank, the bank does not process the check on time. So what I'm trying to say is the bank may have a work overload to the extent that they may actually process your check after a week or some days. So with these we call them uncredited lodgements. Why? Because the bank, in the process of processing the check, may take a week, whilst we are preparing our reconciliation. So we may prepare a reconciliation in the week that the check is still being processed and hasn't been completed. So it means this is not going to be reflected on the bank statement. This uncredited lodgements or this outstanding lodgement may not be or will not be reflected on the bank statement. So it means that us in the cash book have recorded that we received money. A check, we received a check or received money, it's one and the same thing. Received money or a check, it's one and the same thing, right? So we received a payment. Let's just call this a payment, because cash or check, it's the same thing, just that they appear in different forms. But don't get confused by the wording, right? So we received money, so we debit our cash book. So it means we are increasing our cash. We are saying we have more cash now. But in the bank, they have not yet recorded it. They have the documents, but they have not yet recorded them. So the bank statement will come lower, right? It will come to us lower when you request the bank statement. When the business now requests the bank statement from the bank, it will be having a lower balance than that which we expect to be having. So the cash book will actually have a bigger balance than the bank statement. So for beginners, I shall not dwell too deep into the bank reconciliation. I've tried to simplify that much. So these are the basic terms: unpresented checks and outstanding lodgements. These are the two most basic terms you actually find in a bank reconciliation statement. However, we're going to unveil a lot of jargons that then are used in bank reconciliations later on. So I would also like to explain what happens in a bank account at the bank and in the cash book at the business. But to avoid confusion, I will then explain it later, or maybe in another video. Alright, so now we write on the bond the pro forma or format. Now things are getting exciting. So this is the bank reconciliation, pro forma or format. The balance per cash book always comes first. So you take the balance from your cash book. Where do we get this balance from? From the business. So the business gives us an extract of the cash book, and from that extract we take the balance in the cash book prepared by the business. So the balance per cash book, we jot it down. Remember, it's not always positive. Sometimes it may come negative. So be careful to look out for brackets. So if it comes with brackets, it means it's negative. If it comes without brackets, it's positive. Which means by positive, it means the cash book is saying we have money. If it's negative, it means we are in overdraft. We don't have money. We are actually owing. Maybe owing the bank. So next we add unpresented checks. Unpresented checks, like I explained, you pay a supplier with a check. The supplier should submit the check to the bank. But then what happens is the supplier does not then submit to the bank, maybe because the supplier falls sick or something happens on the way. Now if that happens, I have already explained, if that happens, the balance as per cash book and the balance as per bank statement will not match. So an example of an unpresented check: a check payment of $500 for telephone expenses has been entered in the cash book but not yet presented in the bank. So we're saying we gave a supplier $500 for telephone expenses. The supplier did not go with the check to the bank. So we in our cash book have less $500 because we're saying we paid it. But the bank has not yet received the instruction. Remember, a check is an instruction. The bank has not yet received the instruction to transfer the money to the supplier's account. So the bank's balance will be greater than the cash book balance. So what do we do now that is like that? We add the unpresented check. Why? Because we in the cash book subtracted $500. However, because the bank did not subtract the $500, we should add it back in the cash book. So what I'm saying is we subtracted $500 from the cash book. We have to add it back. Tikuti takabvisa $500 mucash book. Tirikufana kuidzorera because $500 ishi haina kumbobvira yabhadharwa. Because check haina kuzopresent kubank, saka haina kubhadharwa 500. Isusu takarekoda tichitabhadhara. But in actual terms haina kutozobhadharwa because supplier haana kuenda necheck iya kubank. Saka chinhu chatakabvisa takufana kuchidzosera. That's the concept here. What we removed should be put back because the payment did not actually occur. So it's a matter of occurrence now. So the matter of this check has to be dealt with accordingly. Now we also have deduct uncredited lodgements. So remember, we add unpresented checks, deduct uncredited lodgements. Now remember, we are coming from the balance of the cash book. That's what you have to keep in your mind. So from the cash book, we actually had added, because remember, it's an uncredited lodgement in the bank, but in our cash book it means that we had actually added that amount to say we have received that amount. In the bank they are saying we did not receive such amount yet. Why? Because the bank statement is not showing it. So the bank is saying we haven't received that amount, but us as a business we are saying we have received that amount. So as a business we are saying we have received it, but the bank is saying we have not. For the balance of the bank statement to match the balance in the cash book statement, we have to go and deduct that amount which we added in the cash book saying we received. We have to remove it. We said we received it, now we have to remove it because the bank is saying we did not receive it yet, right? The bank is saying we haven't received it. We are saying we have received it. So we have to less that uncredited lodgement. We have to deduct it. So if we do that, we get our balance per statement, per the bank statement. So you can actually calculate your balance per bank statement from your balance in the cash book. All you have to do is understand the terminology and understand the meaning of this wording of the bank reconciliation, because it gets tricky. The examiner gets to try to confuse you. They know you know, but they want to see how you apply what you know. So deduct uncredited lodgements. So an example is a check for $125 was received for rent. This has been paid into the bank and entered into the cash book. The transaction is not showing on the bank statement. So I've explained this one. A check for $125 was received for rent. This has been paid into the bank and entered into the cash book. So in the cash book we have recorded that we received $125. The transaction is not showing on the bank statement, but the bank statement now is saying no, we have not received that. So we go less the cash book. We have to deduct from the cash book. Why? Because in the cash book we added. Now we have to deduct it. I hope you're right there. Now if you have questions, the number is on the end of the lesson. So do this question. You pause the screen, do this question. So I'll just explain a few terms here, maybe one I'll explain the second statement, which says LPD has cash in transit to the bank $500. So cash in transit is a form of an uncredited lodgement. So this is an uncredited deposit or lodgement. So a cash in transit, we are saying we are moving money from the business to the bank. So the bank hasn't yet received it. The money is on its way to the bank. So the bank hasn't yet received it, which means this amount will not reflect on the bank statement. So it's an uncredited lodgement. It's a form of an uncredited lodgement. So we treat it the same as an uncredited lodgement. I hope I have given you a clue there. So I'll pose the question to the question, and then you find the answer in 5, 4, 3, 2, 1. So this is the answer to the question. If you got everything correct, then that's it, keep it up. And if you didn't, accounting is a subject which you have to have a consistency with, and also practicing is very essential in accounting. So you may have to repeat the video or contact me for an alternative explanation to the reconciliation subject. Good luck in your endeavors.